Hi there, and welcome to week 11 of Finance, Financial Markets and Institutions. And in this lecture, we're going to cover the equities market. So far, we've covered the various regulatory aspects within the module. We've looked at the individuals within the markets who are authorized by the Conduct Authority, and we've looked at the prudential regulator who authorizes the firms and the markets themselves. This equities lecture will be done in the context of a capitalist society. We'll briefly mention the likes of investment banks and their role from week 8. We've covered the money markets, but as noted last week, the bond and equity markets are also known as the capital market. So in this lecture, in part 1, we're going to briefly describe the basic characteristics of equities, a brief history, and what makes up the markets. In part 2, we're going to look at the 3 types of equity value evaluations. And in the final part, we're going to look at stock market efficiency theory and the concept of, can investors actually beat the market? So, what is a share? Or what is equity? Both terminologies are kind of interchangeable. Essentially, it is ownership of a company. Shares are typically issued in the primary market, and if you buy the share or become an equity holder, then the company that issues it has no legal obligation to pay you this back. Essentially, it's a bit of paper that says you own this company, you have a claim to its profits, but the company does not legally have to pay you back the initial capital investment. A share will exist as long as the company exists, unless, of course, the company buys the shares back and becomes private again. Shares, or ownership in an organisation, is actually one of the oldest tradable securities that's noted and documented within history. This on the screen is an example of one of the first ever shares issued. Now, this is by the Dutch East Indian Company, which actually formed in 1602, but sold ownership or equity 4 years later. And this was essentially a company that needed to raise money to finance exploration trips around the world to explore new regions, with the hope of bringing back minerals, resources and spices. So this company sold its ownership in the hope that it would return from its trips with the goods and then be able to sell it on to make itself profitable and then distribute its wealth back to its owners. But how did the London Stock Exchange start? Well, like any good thing, it started with a cup of coffee. I don't actually know if that's a saying, but I'm making it anyway. The London Stock Exchange was just a coffee shop. It was Jonathan's coffee shop. So in 1698, this is where individuals would appear at the coffee shop and potentially talk about their businesses, trade ideas. They would trade ownership, but they'd also trade items. So, you could trade cattle or sheep and so on. So this is where securities over a brew were discussed and traded amongst individuals. Then in 1773, this is where an actual group of 150 stockbrokers and jobbers would come together and actually create more of a formal establishment. It was known at the time as the New Jonathan's because it was still a coffee shop with a trading room on a different floor. And this is eventually what changed its name to a stock exchange. And then more formally, in 1801, it became a kind of subscription-based sort of organisation when there would be membership rules and reasons and criteria for joining, thus becoming kind of the first regulated exchange, because the participants wouldn't just be someone that walked in off the street for a cup of coffee. It would be a more subscription-based, you'd have to be registered and authorised. So this is kind of where the modern regulated stock exchange was originally born from. Now, for any historians here, these things will happen all over the UK. So in Newcastle, if anyone's ever been to the Lytton Phil Library, there's a room in there that looks like an auditorium or lecture hall where you may sit and watch a performance. But originally, that was kind of a place where investors would go and sit and watch presentations by people that would present their business or their invention. If you know anything about the British Railway and Newcastle's heritage with George Stephenson, then I believe one day George Stephenson was one of the presenters selling his idea to potential investors, which might have potentially helped the birth of the steam invention and the railway in general. But as an owner, so you've bought the share, then what does that actually mean? Well, it doesn't mean you run the business, you just own the business. You have a claim to its profits. Who runs the business is the board of directors, and they should run this business on your behalf. There's plenty of theories out there, the likes of agency theory, which disputes the role of the board. Are they working on behalf of themselves, or are they working on behalf of the shareholders for shareholder wealth maximisation, or the likes of stakeholder benefits and reasons as well? But as a shareholder, you do have a say on the board. So when it comes to the likes of AGMs, annual general meetings, which have to happen once a year, shareholders get to vote on a range of different topics that may be raised by the board, likes of strategy, but also they get to vote on the likes of board and directors' remuneration packages. And if there's any special items such as merger and acquisitions, then shareholders do get to vote on this as well. And each share has a voting right, so if you have more shares, you technically would have more voting rights. So there is a bit of an issue here, as small individual investors may feel that they don't have much say compared to the likes of institutional investors, which are the likes of your pension funds and your hedge funds, who are the people that own the majority of the shares of organisations. So institutional investors do have a large say on how potentially companies do operate. As a shareholder, you don't have legal responsibility to the likes of debt. You have a limited liability, so the likes of debt and bond coupon payments and loans, they're the responsibility of the company and not its owners. As a shareholder, you are taking an additional level of risk. You have a claim on profits, but this is not guaranteed. Dividends are typically paid after tax on the net profit. Therefore, if the company doesn't make profit, then typically dividends are not paid. If your firm that you've invested in as an owner goes into liquidation, then, as I mentioned before, the likelihood of you getting your capital back might be zero. Shareholders and owners are paid last in the liquidation hierarchy. We mentioned this last week when we talked about bonds. Coupon payments on bonds are a legal requirement. Dividends are not. In the form of liquidation, bondholders are paid back their debt first, ahead of any shareholders. So there's a difference between the level of risk on the products. That's why we mentioned last week that bondholders tend to be more naturally risk averse. As an investor, you obviously need to look at the likes of dividend track record. So some companies do tend to have a good track record. Some certain industries and sectors tend to be more generous when it comes to dividends than others. But it also depends on the stage of growth of the company. If the company's quite small and still growing, you'd rather they reinvested their after-tax profits into the organisation to grow and expand rather than pay dividends. So it really depends on the kind of the period of growth that organisation's in. We'll come back to this in a second. There is different types of shares out there. Typically, the ones we know is ordinary shares. These are the ones that have the voting rights, where you have a claim on the likes of profit through the dividends. But there is other ones out there, other types of shares. So we have preference shareholders. These are, again, still ownership, but they do kind of have characteristics like bonds. Not in the fact you'll get your capital back, because that doesn't exist, but it comes to the dividends are actually fixed and potentially more mandatory. So a preference shareholder would expect to receive a dividend. And this could be a fixed or variable rate, and if the likes of the dividend is not paid to the preference shareholders, then they will accumulate and they will have to be paid at some point. And they will be paid ahead of the ordinary shareholders. But if you are a preference shareholder, this means you would sacrifice any voting rights. So you wouldn't be able to vote at an AGM. You don't have a say in how the business is operated from that point of view. When you do your readings from the core textbook, you might notice there's a few more different share types that are not as common, but you can have ordinary shares that do not have voting rights. You potentially have ones that give you less claim on the dividends. And there may also be types of shares where you have kind of vetoes and extra voting rights when it comes to any sort of special actions, such as merger and acquisitions. But as a company grows, then the types of ownership and equity out there will change, because you can't list on a stock exchange from day one. So when you start an organisation, most of the ownership is with the individuals that start the company, their savings, their capital. They may get loans to help them, but that's not ownership. The ownership still stays with the individual and what they put in. So as a startup, if you want to raise equity, typically you're going to go to entrepreneurial capital, angel investors, and crowdfunding. This is where you put your idea out there and try to get investors to take ownership. So you might be familiar with the likes of Dragon's Den, the TV show, their types of entrepreneurial capital. And this is obviously quite high risk because it could just be an idea. There's potentially no proven record at this time. So it's quite high risk as an owner if you're going to invest into this. But as the company grows, then there's other avenues to get equity capital. Now that the firm has a proven record, they may have at least 3 years worth of accounts to prove this, then the likes of venture capitalists or private equity companies may be interested to potentially buy ownership into the firms as they grow. And also this is a stage where companies may list in the UK, we have something called the FTSE AIM market. And the AIM market on the London Stock Exchange is a more market for kind of sandbox where the regulations aren't as tight, the amount of transparency, the amount of data provided, the cost is much lower. So you can list on the London Stock Exchange on the AIM market, which is cheaper for you than going to full listing. Well, it's kind of foot in the door type thing, and it does get you to kind of be more public and listed, and it's a foot to kind of grow in market cap to try and get on to the larger exchanges in the future. And then as you grow into maturity, then this is where you may go from the AIM market to kind of the full listed market. And this could be joining the FTSE All Share, going up to 350, 250, FTSE 100 potentially. And this is obviously as the business cycle of your organisation grows, you've got a more track history and you understand the process of listing, the costs involved, then this is how you would hopefully progress. And it's really at the end of growth and the maturity stage when the likes of dividend payment policy becomes more important, and you potentially do have the profits to provide back to your investors. Like I said, at the start and the early growth stage, you're probably not going to pay dividends because you want to reinvest your dividends into your organisation. And obviously the equity investors at this time will obviously appreciate and understand that. Being listed or selling ownership does provide various benefits to an organisation. It is, like I said, a way of raising capital, and this capital doesn't need to be paid back, so you can invest in your organisation. If you're listed, then technically you have a price on your head, and this price could be seen as a target to kind of help grow your organisation, a level of prestige. If you're listed, then counterparties will know who you are, they'll know that you adhere to the listed rules, therefore you're open, transparent, there's publicly available data for you, and this could potentially lead to new investors or new supply lines, or even new customers. If you're listed, then of course you can distribute ownership amongst your employees as an employee incentivization, and introduce the likes of share saving schemes to get your employees invested. If you're listed with a track record, then you may potentially want to list on another exchange in a different country to raise additional capital or to expand your business overseas and so on. But there is a risk. Because you have a price on your head, then potentially you could be a target in the case of merger and acquisitions. But also, if you're listed, then you can sell additional shares to raise finance to do your own merger and acquisitions, which we'll come on to in a second. So how do we actually work out the total value of a company? We use the terminology of market capitalization, and this is essentially the share price of the company times by the number of shares in issue is the market cap, or the value of the company. And then if we want to work out the total value of the stock market, then we know the market cap of each company. We just add all them together to work out market capitalization of the stock market itself. If we do a very quick mathematical example for this, we have on the screen a company that has issued 10 million shares, and each share is currently valued at £3.26. Now, if this was the UK stock exchange, it would just say 326. We have to realise that that means £3.26. So to work out the market cap, very quickly and easily, we just times 10 million shares by the share price. So this company is clearly valued at £32,600,000. If the likes of the share price goes up, we'll say 5 pence. So tomorrow the share price is £3.31. Then we can work out how much the company value is increased by simply timesing the 5 pence by 10 million. So essentially the company value will have gone up by £500,000, which is 500,000. But there is one thing to note here. Some people say, well, that company's more expensive than that company, therefore that company's better. That's not a good way of looking at things, because that company might have a high share price because it doesn't have many shares in issue compared to the other company. Share prices, we'll go on to valuation techniques later, but ultimately share prices move based on supply and demand. If the supply is low because the number of shares is fixed, and if there's not many shares out there, then of course the share price, if the company's performed well, could be higher if demand increases because there's not many shares out there. The London Stock Exchange does produce data on various aspects. If you go to the londonstockexchange.com and look at their resources section, they'll give you plenty of information regarding market values, current share prices. You can download all the historic data in Excel, and they have various different reports. This report on the screen is a little bit old because I simply couldn't find the PDF of the latest one, but it gives you an idea of the size of the companies that are listed on the London Stock Exchange. And the majority of the companies, 289 of them, have a market cap ranging from 0 to 25 million. And in the UK listed, there's only, at the time of this report in summer last year, 19 companies that were valued at over 50 billion from market cap point of view. It'd be very interesting if you were to look and get a similar chart today to kind of compare how the impact of the market correction in March 2020 has impacted the overall value of the firms, and see how many companies have actually gone down in market value following the market correction. But what you've seen throughout 2020 is, since the market correction, the likes of the FTSE 100 and FTSE 250, up until the end of the year, the time of recording in December, the exchanges have risen from that correction to be up by about 20 to 30% since March. But in March, the markets did take like a 40% hit. at the end of December, there's still room to get back to pre-COVID market capitalization levels. To finish off the terminology here, companies, when they list into the primary market, and then the shares are traded on the London Stock Exchange, which is known as the secondary market. Following listings, companies can raise additional equity via issuing of new shares. There is a number of terminologies here. Firstly, in the primary market, when a company does actually list, what normally happens is this is where the investment banks get involved, also known as the market makers. They will potentially buy the company's equity, all of it, as the market maker, which is also known as underwriting the issue. And then the market maker, the investment bank, will sell the shares to the market by the brokers. So company wants to list, it will sell all its ownership to its investment bank. Its investment bank, who then at the minute technically owns the company, will sell all that equity ownership via the exchange to investors and other institutional investors. But then later on, if a company wants to issue more shares in the primary market, then they would do it potentially via a rights issue. And this is where you would issue new shares to current shareholders at a discount. So it would be discounted from the current share price. And this is obviously to incentivize current shareholders to buy the new shares because they might make an instant capital gain from whatever the discount is compared to the share price. But of course, if they issue a heavy discount, then the market will obviously correct the current share price potentially lower. Depending on the scale of the rights issue, it probably won't go all the way down to the level of discount, because rights issues typically issue less equity than that's currently out there. There's also other types like scrip issues, and this is where you issue new shares to current shareholders again on a proportion basis, but this would be for free, so you give them like an additional share. And this just helps to dilute the price and potentially lowers, because there's more supply out there, it lowers the volatility, or when share prices, when demand increases, there's more shares out there, so there's less volatility of the share price. There's also things like stock splits, where if you're a shareholder, you've got, say an example, you've got 10 shares that are valued at £1, therefore you've got an ownership at £10. If there's a stock split for 2 for 1, then what you'd see is you'd have 20 shares, but now at 50 pence, therefore your ownership is still £10, but you now have 20 shares. So again, this dilutes the number of shares out there and lowers the price, but the market cap stays the same, all else being equal, of course. Again, this is seen as a way of reducing the share price and lowering price volatility. Some companies, very famously Apple, have done this quite often in recent years, and they do quite large stock splits, like 1 for 7 or 1 for 6. And this really drives the price down. So this is kind of a marketing tool to potential individual investors to say, oh, shares are now a lot lower, therefore you can invest in Apple, and you can be a retail investor and buy their shares to support the business, rather than their customers think, oh well, shares are only for institutional investors who can afford to pay X amount, because Apple share price did get expensive. So it is potentially seen as a way of getting more individual investors rather than institutional investors. And in the recent history, well, in 2020 there hasn't been many IPOs to talk about, but certainly in 2018 and 2019 there was quite a lot of IPOs, certainly in the US. There was quite a lot of articles about unicorns, which is a terminology for companies that didn't really have any profit, but yet they were great ideas. So on the screen you've got the likes of Snapchat and Uber and Slack, who hadn't really made profit. In fact, they hadn't made profit, and they weren't actually forecast to make profit for a number of years yet. But they listed to great success, and they raised a lot of equity capital to invest in their businesses. And this was because investors, either behavioral the fear of missing out, but also they had the belief that they will be profitable and that they will change the market moving forward. So they had very successful IPOs despite making no profit or forecasted not to make profit for at least a number of years. But because of their idea and the way they were changing the markets they were in, they were very successful at IPO. And at time of recording, in early December 2020, Slack has just been an announcement that a company wants to buy Slack. So that is potentially seen as, alright, it is listed, it's publicly owned now, but therefore it has a price on its head and it has shares out there that another organisation could buy. So you can now go and have a quick look at this example. So if you're not familiar, Slack is kind of like a workplace messaging app. Obviously during COVID, very popular given the remote working. It's sort of seen as kind of a much better alternative to the likes of Microsoft Teams and so on. But they've just been bought by another business software giant. So look up Salesforce, again, an American company. But yeah, recently Slack has been sold to this Salesforce business software giant for a total of $27.7 billion US. So given that this company only recently listed within the last year or two on the US stock exchange, it's just been bought by another company, $27.7 billion US. And this is, I suppose, one of the risks that you face if you're listed. You could be bought, but obviously the shareholders of Slack will have potentially had voting rights to reject this merger and acquisition. And this example concludes the first part of the lecture.